Hi, my name is Mahmood Reza. I'm going to be presenting a short session on tax returns, a guide. Some of you will be doing your tax returns already, some of you will be used to it, this is probably either a top up and a refresher. If it's new to you, then there'll be some valuable takeaways either way. Now, the main things that we're going to cover in this presentation are as follows. We're going to look at who needs to actually complete a tax return, who does it apply to. We're going to talk about what's needed to go actually in the return, what does it capture, what's the information that you're required to complete. We're going to look at what you can actually claim within your tax return if you're, say, a sole trader. And lastly, we're going to look at the relevant dates and payments. Dates are really quite key in tax because if you don't comply with statutory dates, then normally there will be a financial consequence by way of a penalty. So the first discussion or overview is about who needs to actually bother, who needs to actually complete a tax return. And they are as follows. The self-employed. So if you are self-employed and you have over £1,000 worth of income, then you need to complete a tax return. If you're classified as a higher rate taxpayer, in other words, you've got income in excess of 46,350 and you also have income that's not being taxed, such as rental income, then you've got to complete a tax return. If you're a company director, normally you're expected to complete a tax return. If you're a director of a not-for-profit organisation and you haven't received any financial benefits from that company, then no return is needed. If you or your partner has income in excess of 50,000 and you're also receiving child benefit, you need to complete a tax return. If you've had activities which have generated losses, so for example a property business, self-employed business or capital losses, to claim the benefit of those losses, which seems quite a strange thing to say, you need to complete a tax return. Now lastly, even though it's an income tax return in most people's eyes, if you've got any capital transactions, so for example you've sold some shares, you've sold second homes, you've sold investment property and the like, then you need to complete a tax return in respect of any capital profits, approximately over 11,700. Now what does the start of this work out like? Now the tax return fundamentally, the calculations for it is going to be based on income that you have from everywhere, less the costs and the allowances. That gives you your initial tax bill, take off any tax you've paid already, and bingo. First thing is, within the return, there's two sections. There's the core return, which will capture information about who you are, your unique tax reference, your name, date of birth, details of any savings, pension payments, gift aid claims, etc. The extra is sometimes called supplementary pages, and that will include details of employment income, self-employed income, property income, partnerships, foreign income, capital gains, and if you're a non-UK resident or a dual resident, there's a section there for you as well. Now, prior to actually entering anything to the tax return, it's usually a good situation to gather all the information that you need. We normally supply our clients with a checklist to go through, so they've got a good idea of what they've got to gather. So gather it all together, it makes the process slightly easier. Now the documentation that goes with that information will depend on the nature of the income that you're recording and including. So for employment income, typically the documents will be a P60, a P11D and or a P45. If you're self-employed, your business accounts will be the basis of those numbers. If you're a property investor and you've got rental property, then it's the rental accounts that will be the source of that information and a supporting document. Now the estimates, if for any reason you've misplaced some invoices, some bills, you can't quite evidence what you spent, then reasonable estimates based on something will be better than nothing. If you happen to be self-employed, I'm just going to focus on this for a minute or two, then the tax that you pay is based on the taxable business profits. Effectively, what have you charged your customers less all tax allowable business costs. 4 things to bear in mind. Those idea of business costs are they must be incurred and therefore business purposes. So strictly speaking, if you go on holiday, your business pays for your holiday, the cost of that holiday is not a business expense. Contrasted, if you go on a business trip and you happen to have residually a bit of holiday, that's a slightly different proposition. You may have some expenses and costs that you've paid for personally or going through the business, which have got a mixed use, i.e. some of that is for business, some of it is for personal. Typical examples that spring to mind: your mobile phone. The cost of that phone will be partly for business and partly for personal calls. Other things could be computer usage, vehicles. By concession only, HMRC will allow you to make a reasonable split of how much is business and how much is personal. This doesn't apply for companies, unfortunately. Only for sole traders is one allowed to do that. You may make what's called capital purchases for your business. So think of it this way: you might buy things like PCs, vans, equipment. Typically those things are used for the long term, part of the infrastructure of the business, and there's a special regime called the capital allowance regime which governs what you can claim. In some cases you can claim the whole cost of the item. In some other instances, like for vehicles, there's a reduced allowance claim. I'm going to mention entertainment here on the grounds that in commercial circumstances you may be in a situation where you entertain clients and suppliers because they're important to you. You wish to keep them a good relationship going. Those expenses are not allowed for tax purposes. Now there is a regime here called the Simplified Expenses regime, which is effectively using scale rates, fixed rates of deductions compared to looking at the actual costs in your business of these items. So 2 things to bear in mind. Number 1, who does it apply to? And this regime is applicable and claimable by sole traders and partnerships. You have to have sales below the VAT registration limit, currently £85,000. The 2 areas that we're going to look at in this slide are in respect of vehicles that you use in your business and working at home, partly or fully. Now by vehicles we're talking about anything that's a transportation mode to help you in your business. So cars, you can claim 45 pence per each business mile travelled, up to 10,000. When it goes over 10,000, it's 25 pence per mile thereafter. This typically, by the way, will cover the cost of purchase of the vehicle, insurance, car tax, repairs and petrol. Motorcycles, if you happen to use a motorbike in your business, then you can claim 24 pence per business mile. And lastly, for reasons of fitness, convenience, being eco-friendly or whatever, if you happen to use a bike in your business, for visiting clients and the like, then 20 pence per business mile is allowed. The other area that I was going to look at in terms of the simplified expense regime is when you work at home, either partly or fully. If you're doing some work at home, then you can use a skill rate to determine what you can claim. And the skill rate is based on how many hours you're working in your business. So it starts at the lowest, an average of 25 to 50 hours per month allows you to claim £10 per month. If you work at home more than 101 hours per month on average, then you can claim £26 per month. And that would include things like checking your social media, updating your accounts, quoting, looking at your website. Anything that's business related will be part of those hours. Key dates, which we mentioned earlier on. And the dates are important because if we don't comply with the dates, then we could end up getting a penalty. Firstly, make sure you've actually registered and you're in the sites of HMRC. You are allowed to Well, not allowed to, but you have to register with HMRC by the 5th of October in your business's second year. When it comes time to sending in the returns to HMRC, paper format is allowed or online digital format is allowed. If it's paper returns, you've got to submit these by the 31st of October 2019. If it's digital and online, you've got until the 31st of January 2020. Now, potentially the painful part is when it comes to pay HMRC. Any tax that is owing can be collected via your tax code if you're under PAYE. It's got to be no more than 3,000 and the return has got to get there by the 30th of December 2019. If that doesn't apply to you or you don't wish to have it collected via your code, any money that is owed must be paid by the 31st of January 2020. It may also be that you have to pay an additional amount called a payment on account. Think of it like payment up front towards next year's tax bill. Now, as an illustration, if you owe HMRC, say, 4,000, then what they will say, by the 31st of January 2020, we want the 4 grand, half of that also up front to go towards next year's bill. So you've got to pay £6,000 by 31st of January. The following 31st of July, you've got to pay another £2,000 payment on account. If circumstances are such that you think next year's is going to be slightly lower or much lower, then you can claim to reduce those payments on account. If for any reason, and it does happen over time, that circumstances change, the money that you may have put aside to pay your tax may not be there, you may do your tax return quite late and you're unaware of what the liabilities actually are, then you may not be able to pay. So what one should do, first of all, do not impersonate an ostrich. Don't stick your head in the sand, confront it, get that return in, otherwise you won't be able to have any conversations with HMRC. Number 2, if you are unable to pay, once your return has been submitted, you can make contact with HMRC's Debt Management Unit. There is a time to pay section and they will discuss with you instalment arrangements on the tax that you owe. Interest will be charged on that, but it's at a very notional rate there. So again, probably cheaper than a bank overdraft. If you decide to do that ostrich impression and ignore what needs to be done, then you run the risk of being pursued by a private debt collection agency, of which HMRC have quite a number. Okay, well, hopefully you found that useful. Hope you got some takeaways there. If you have found it useful, please, we'd love it if you could like, share, comment, distribute accordingly. There's some blog details on our website. We'd love you to go and have a look. If we don't actually meet again, or we do meet again, best of luck with your tax return filing. Don't panic, get it dealt with, and best of luck.